Hello and welcome to this video module on basic financial modeling, part 1 of 3. What is a financial model and why do bankers use them? A financial model is a tool used to forecast a company's results. It's crucial that it's designed to allow for easy alteration of assumptions so that multiple scenarios can be evaluated. Those might be operating scenarios such as high growth, low growth, or financing scenarios. Suppose we finance a company with 60% of its cap structure as debt versus 80%. The financial model most frequently takes the form of an Excel spreadsheet. Investment bankers are heavy users of financial models, and junior bankers in particular are expected to be adept at or even experts at reading, altering, and creating models. Why? Because models are integral to valuation. They're used to forecast the free cash flow line that's used in a discounted cash flow or DCF valuation, and more complex models are used in leverage buyout analyses. That includes those financing structures I mentioned before. How much could a financial buyer pay for something? Well, we could put in certain debt assumptions and see what purchase price they can still pay while getting the returns that they need for their investors. Models are also used by bankers on restructuring engagements and in debt deals to prove that future obligations can be met. This module and the two following modules will walk students through the creation of a basic financial prediction model. A few advanced topics are going to be avoided as they're addressed in this course's Advanced Modeling Topics module. Those topics include cash flow sweep, where excess cash is used to pay down debt, operating case toggles, depreciation tables, deferred taxes, tax tables. These are all just topics that make a model a little more realistic, matching real-world scenarios. Payable in kind debt, and we'll also look at the use of certain Excel functions such as offset, match, and the lookup functions. And I'll show you how to put in Excel controls such as buttons, check boxes, and list boxes. There are 10 steps that we follow to create a basic financial model. We're going to go through these in the modules, but they're laid out here. Basically, we're going to forecast the income statement to the EBITDA line, which basically just means forecasting revenue, cost of goods, and selling and general admin. We're going to forecast key balance sheet items such as accounts receivable, inventory, and payables. We're going to set up the cash flow statement to capture all those changes on the balance sheet and capture some data coming in from the income statement. So we're going to forecast the operating activities and the investing activities, basically capital expenditures, but not the financing activities at this time. We're next going to link the capital improvements from the cash flow to the PP&E line on the balance sheet and link the depreciation on the balance sheet to its line on the income statement. We're going to perform the depreciation calculation on the income statement in step 5. Step 6, and basically 6 through 9 are kind of all grouped together as having to do with debt, whereas 1 through 3 were kind of self-contained, just forecasting the basics of the income statement, balance sheet, and cash flow statement. Steps 5 and 6 here address some of the items such as capital expenditures and depreciation that cross between two of the statements. 6 through 9 covers debt. So we're going to set up a debt and interest schedule, which will include interest rates, beginning balances, new borrowing, amortization of new or existing borrowing, and ending balances and interest amounts. We're going to link those interest amounts to the income statement, excluding the interest earned on cash, and we're going to continue the income statement calculations down through the bottom line. In step 8, we're simply going to link debt balances from the debt and interest schedule to the balance sheet. Step 9, we're going to input a formula for line of credit borrowing or repayment on the cash flow statement and link that activity to the debt schedule. That's a complex formula, but it basically makes sure that our model, if needed, will borrow rather than go into a negative cash situation. Finally, the fun part, we're going to link the ending cash from the cash flow to the top of the balance sheet. We'll calculate the cash interest, but this is where the model all comes together and everything balances. Let's take a look at some of the images. Here's a copy of an income statement. This is what we're going to use for our module here, and we're going to focus on the green highlighted cells. You can see we have 3 years of historicals, 1, 2, and 3, and then I've set it up with 3 years of projections. But as we said in step 1, we're going to go through, we're going to forecast net revenue, we're going to forecast cost of goods sold, we're going to forecast selling, general, and admin, and that's going to get us to the EBITDA line. We're going to leave out, for now, at the beginning, depreciation and interest calculations, and then we can't calculate our taxes yet because we don't know our pre-tax income. Likewise, here's a balance sheet, and we're similarly going to focus on the green shaded areas. So we have historicals, we have historical receivables and inventory. We're going to use some data to forecast our receivables, forecast inventory, forecast payables, and for now we're going to leave out cash, which will be the last step of the 10 steps. We're going to leave out PP&E and depreciation and leave out things having to do with debt. And likewise, from the get-go, cash flow statement looks pretty complete because it's simply a lot of formulas that capture changes elsewhere. We can capture the cash from the balance sheet, we can capture the net income from the income statement, and we can capture the D&A from the income statement, as well as capturing the changes in balance sheet items right here. We are going to forecast early on, forecast our PP&E investments, and later on address the financing activities, the borrowing, repayments, and the line of credit. For this three-part module, we are going to avoid cash flow sweep down below. The final page here in this module just shows us the debt and interest schedule, along with this copy of the assumptions page that we're going to use. Debt and interest schedule, you can see, is pretty basic. We're going to have an interest rate that we're going to put in. We're going to have a beginning amount. We're going to show basically borrowing a repayment, which for the line of credit is going to be sweep activity that's tied to the cash flow statement. And on the senior debt, we're going to have new borrowing formula, as well as scheduled amortization, basically how we pay off that new borrowing. All of this gives us ending amounts and interest. And finally, when you open up your Excel model, you see the first page is an assumptions page. This lets us input a few things, which I've used blue font for. The title of our company, a label to tell readers what units we're using, and just some other key items such as days receivable, terms on inventory, likewise some sales growth. We're going to ignore some of the gray cells for now, as those will be dealt with in the advanced modeling topics. That's it for now. Next two modules, we'll actually dig into Excel on the actual modeling.